Hey everyone, welcome back to Corporate Decoder, the place where we decode the money moves of big corporations. And today it seems S&P Global is giving us a whole lot of numbers to unpack. Buckle up because it's going to be a wild ride through their latest quarterly report. Before we dive in, if you love getting these unfiltered looks at company financials, make sure you hit that subscribe button and maybe even join our Discord community linked in the description below so you don't miss out. Alright, so looking at the big picture, S&P Global, the company behind those credit ratings and stock market indexes we hear about all the time, just dropped their latest quarterly report. And let me tell you, the numbers are telling a story. They're talking about revenue going up, profits increasing, but also carrying a lot of debt. Let's break it down. First up, the income statement. For the 3 months ending June 30th, revenue hit a solid $3,755 million. That's up 6% from the same time last year. And looking at the 6-month period, revenue is up 7% to $7,532 million. Pretty good growth there. Now, what about their operating profit, which is basically the money they make from their core business before things like interest and taxes? For the 3 months, it's up 7% to $1,551 million. And for the 6 months, it's up a healthy 10% to $3,129 million. These are strong gains showing their main operations are performing well. Digging a bit deeper into revenue, it's interesting to see how it breaks down. Subscription revenue is holding strong, making up about 51-52% of their total income, which means they have a good chunk of predictable income. That's always a good sign for investors. Let's see how the segments are doing. Their market intelligence division, which provides data and analytics, saw revenue tick up 5% for the 6-month period, but operating profit in this area jumped a pretty impressive 14%. That's a sign they're becoming more efficient in this segment, which is always a win. Now, S&P Global Ratings, their credit rating business, also saw revenue growth up 5% over 6 months. However, their operating profit here grew 5% too, which is decent but not as explosive as market intelligence. It seems like their core ratings business is steady but not breaking any speed records. Then we have Commodity Insights, up a strong 9% in revenue for the 6 months. Their operating profit here is up a solid 13%. This segment seems to be performing very well, likely driven by demand for market data in volatile times. The mobility segment, which they're planning to spin off, saw revenue grow 9% over 6 months. But this is a big change. They announced their plan to separate this business in April of 2025. This means they're essentially carving out a whole part of the company into a new, separate, publicly traded business. It's a major strategic move, and they expect to be tax-free for their shareholders. This kind of move often signals that management believes the mobility business will do better on its own, or that it will unlock more value for shareholders this way. And indices. Their index provider business is really shining. Revenue is up a fantastic 15% over 6 months, and their operating profit up a massive 17%. That's driven by higher asset-linked fees, likely due to more money being invested in ETFs and mutual funds that track their indexes, and also higher trading volumes. Now let's talk about the company's cash flow and financial health overall. Their cash and cash equivalents are up to $1,847 million. That's a good increase from the end of last year. Cash from operations is a key indicator of a company's health. For the first 6 months, it was $2,398 million. That's a small dip, down 4% from last year, mainly due to higher compensation payments and some one-time items related to the termination of financial contracts. They also break down their free cash flow, which is the cash left over after capital spending and other necessary expenses. Free cash flow fell 8% to 2001 on share repurchases. Speaking of share repurchases, they've been buying back their own stock quite aggressively. In the first 6 months of 2025, they spent $1.3 billion on this, which is a big jump from the $500 million they spent in the same period last year. This is a way companies return value to shareholders, but it also means less cash is available for other things like growth investments or debt repayment. And that brings us to their debt. They have quite a bit of it, totaling over $11 billion in long-term debt. While this isn't unusual for a company of this size, it's something to keep an eye on, especially with those share buybacks. It's like they're taking on more debt to buy back stock, which can be a risky strategy if not managed carefully. Looking at the details of their debt, it seems they've been paying down some of their shorter term notes, like the 4.75% senior notes due in 2025, which are now down to almost nothing, but they have a lot of different senior notes with various interest rates and maturity dates spread out for a long time. It's also crucial to look at their legal matters and potential risks. They mention a class action lawsuit in Australia related to investments made before the 2005 financial crisis. While they've reached an agreement to settle with some parties, the outcome of the class action remains uncertain. They also handle many regulatory reviews, as S&P Ratings is a heavily regulated business. Any adverse judgments or penalties could impact their financial health. This is a constant background risk for companies in this sector. Now let's look at their strategy. They talk about powering global markets, focusing on customer experience, growing their core businesses, and innovating with AI. They're also aiming to deliver strong financial goals and return capital to shareholders. The separation of their mobility business is a big part of this strategy, aiming to unlock value and allow both businesses to focus on their own growth paths. Looking at the overall comparison of the 3 and 6 months, revenue is up, operating profit is up, and their diluted earnings per share are also up. That's generally positive news, showing the company is growing and becoming more profitable. However, their provision for income taxes has also increased significantly by 17% for the 3-month period and 23% for the 6-month period. This means a larger portion of their profits is going to taxes, which is understandable but does eat into the net profit. They also mention new tax laws like the One Big Beautiful Bill Act, which they are still evaluating. So what's the verdict on S&P Global? On one hand, they show strong revenue growth across most of their segments, particularly in market intelligence and indices. Their operating profit is also growing nicely, showing good cost control and efficiency. The strategic separation of mobility could be a smart move to focus on core strengths. However, the increasing debt levels coupled with significant share buybacks do raise a flag. It's a balancing act between returning cash to shareholders and maintaining a strong balance sheet. While their core rating business shows steady performance, it's the growth in data and analytics that seems to be powering the company forward. The risks are there, with ongoing legal and regulatory scrutiny being a constant factor for S&P. But overall, the company appears to be navigating economic challenges and executing its strategy effectively. What do you think about S&P Global's financial performance and their plan to spin off the mobility segment? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into corporate filings from around the world. And remember, you can join the conversation and get even more insights by checking out our Discord community in the description. Thanks for watching, and I'll see you next time on Corporate Decoder.